Hello, everyone. Today we map the four hubs that drive the global equity complex. First is the S&P 500, 500 large U.S. companies that make up more than half of world stock market value. When America catches a cold, the rest of the world often runs a fever. Second is the STOXX 100, the big U.S. growth and tech names that often set the tone for risk appetite worldwide. Third is Japan's Nikkei 225 Tokyo-listed stocks, scored with a long-running price-weighted method. Fourth is Europe's STOXX 600 companies across 17 European countries, all in one index. If you can read how these four move together, you get an early feel for how the next U.S. session may open. Let's walk through them one by one. An index is the market's thermometer. It compresses hundreds of stocks into one number, so you can read the whole tape at a glance. Every index is built in 3 steps. First, choose which stocks go in. Second, decide how much weight each one gets. Third, update that number in real time. The second piece, the weighting method, matters most. The same 100 stocks can produce totally different indexes depending on how you mix them. Think of averaging a classroom's height. Do you count every student equally, or give heavier students more pull? Market cap weighting, for example, gives the biggest companies the biggest voice, the size the market assigns them in dollars. Another style weights by the share price itself, so an expensive stock can dominate even if the company is smaller. To read an index, start with who calculates it and how. Now we'll use the charts on screen to see how each market does that math. The S&P 500 on your screen is America's flagship index. It holds 500 large companies listed on the NYSE and Nasdaq. Getting in is strict. Market cap has to be large enough. The company needs a solid operating history, typically at least a year, and enough shares must float with the public. Weights use free float market cap. Company size counted only from shares everyday investors can actually trade. Bigger float market cap means more index pull. A $500 billion company and a $5 trillion company each count as one name, but the larger one can move the index about 10 times as hard. One caveat: lately the top 10 megacaps have made up roughly 35 to 40% of the index, so a handful of giants drive a lot of the move. In March, June, September, and December, the committee refreshes the roster. Weak names out, stronger candidates in, which helps keep the benchmark trustworthy. The STOXX 100 on screen is the growth in tech heavyweight list. About 100 of the largest non-financial names on STOXX. It is not the whole U.S. market. It is a concentrated slice of it. The S&P 500 is broader, but even there the top 10 names can approach about 39% of the weight. On the STOXX 100, megacap leaders like Apple, Microsoft, and the rest of the Magnificent Seven can dominate even more. When a few giants own that much of the tape, the index can roar or stall on tech alone, while thousands of smaller stocks tell a different story, which is why many investors also watch equal weight S&P or the Russell 2000 for balance. Compared with a true all-market basket, this is like a 10-team league where 2 clubs keep splitting the championship. Concentration is a feature of modern U.S. indexes, not a bug. In a cap-weighted world, smaller names can swing harder. Textbook pattern: the big index drops about 2%, while small caps can fall 5 to 10% in the same stretch. But it depends on the tape. Don't trust averages alone. Check sectors yourself. Japan runs 2 headline indexes with completely different math. That difference is the whole lesson here. The Nikkei 225 on screen takes 225 Tokyo stocks and weights them by share price itself. A stock at 50,000 yen pulls much harder than one at 3,000 yen. even if the companies are different sizes. TOPIX, by contrast, covers about 2,000 Tokyo stocks and weights them by market cap, the company's real dollar scale size. Concrete example, Toyota might be only about 1.2% of the Nikkei 225, yet closer to 3.4% of TOPIX. Same company, nearly a 3 times gap depending on which index you watch. Put both charts side by side and compare the moves yourself. One weighting choice rewrites how you read Japan. The Nikkei is the classic price-weighted symbol. TOPIX is the market cap reality check. STOXX Europe 600 on screen holds 600 stocks across 17 countries, Germany, France, the UK, and more. It is market cap weighted and covers about 90% of the investable European equity universe. In March, June, September, and December, the membership refreshes so new listings and weaker names get reflected. Now the clock. Global markets run like a 24-hour relay. When Asia winds down, Europe is already in gear. When Europe fades, New York wakes up. For a U.S. investor, that means overnight. Tokyo and Seoul have already printed a session, then London and Frankfurt trade into the U.S. pre-market. By the time the cash open hits at 9:30 Eastern, S&P 500 futures, ES, may already have moved a lot. Those overnight futures moves often show up as a gap when U.S. stocks open. Watch that gap on the chart. If you can read it, you start the U.S. day one step ahead, without treating any single overnight move as a sure thing. U.S., Japan, and Europe all use the same GICS framework, the Global Industry Classification Standard, with 11 sectors. That shared map lets you compare the 3 regions on one scorecard. The 11 buckets include communication services, consumer, healthcare, energy, and the rest. Which group leads flips with the cycle. Textbook pattern. When growth firms up, financials and discretionary often lead. When the economy hurts, staples and healthcare tend to hold up better. Real markets also price Fed rate decisions, geopolitics, and the dollar's path, so the pattern does not always fire. History is full of exceptions. The ASEC 100 on screen is the U.S. tech-heavy benchmark. Line it up next to Sector S and compare relative strength. You'll see which industries the market is actually buying right now. That is the practical way to read the global map. Warning: this lesson is for education only and is not investment advice. You alone are responsible for every trade you make.